Mike Green, I'm here in Los Angeles with Wayne Himelsein of Logica. Logica is a hedge fund that is focused primarily on, at least as I think about it, tail risk dynamics, right? But mostly where you and I have bonded in the past is talking about the underlying dynamic of buying volatility, right? So not truly tail risk, but trading volatility. Can you briefly just describe to me what Logica does and what your primary focus is as a strategy? And I know you have a background that I'd like to dig into right after you give me that.
Yeah, rather than a hedge fund, I think we could be that, but we're more of I'd call us an R&D shop. So Logica was started with a focus of building strategies with a quantitative thesis or mathematical thesis. That was my background. So, and that led to a couple of strategies, a market neutral portfolio and a long-only portfolio. And then one of them, as you mentioned, is the volatility portfolio, or volatility trading. I'd say got into that very quickly because the other side of every other strategy is negative skew and volatility being the risk, right? So in building a bunch of strategies over, not just when I started Logica, but in my prior life in being a quant for 15, 20 years before Logica was started, it was the clear realization that whatever strategy was built had, at the end of the day, exposure to volatility. That was kind of the shared pain of everyone. It became clear to me that while there are many exposures and asset classes, volatility is what everybody's invested in at the end of the day. And therefore, we got really dedicated and focused on building a strategy to take advantage of volatility. In the beginning, it was a hedge to the other stuff we were doing. So we had a market neutral portfolio, and we knew that it could consistently pump out a certain return profile, but it had negative skew. So I had this a positive output, but my risk again was volatility. Therefore, building the vol strategy next to that meant that the two together could be a more stable portfolio. And in doing that, I realized that the real beauty wasn't the other stuff; it was the volatility itself, or managing around volatility, because that's what, at the end of the day, everybody needs. That's the grand exposure that we all live with.
Well, and so you've created a way that you're able to profitably trade from a long vol position, right? Which is similar to many of the arguments that I've made around what I think are the appropriate strategies going forward. Real Vision viewers have heard this over and over again. Have these opportunities always existed in the market, do you think, to trade from a profitable standpoint to be long volatility? Or do you think this is somewhat of a temporal feature of a market in which people are increasingly not just implicitly being short vol, right? So buying equities or building a skyscraper or doing any form of investment has a short vol component to it, right? You're anticipating that the future looks an awful lot like the past and doesn't have a discontinuous break associated with it.
Sure.
But historically, tail funds or funds that have traded long volatility have experienced negative continuous returns, right? So they've had negative results. That's not been your experience with Logica.
Right. So the question being is it temporary, or is it a sign of the times, or is it possible?
It can be skill, right? Or it can be skill in the right environment.
Absolutely. Could be, or both.
Right.
Right. So I'd say let me separate it. It might be a better environment. To your point, there's more short vol exposure these days than there ever has been, right? So in the drive for yield, everyone's getting short vol, and more so. And in the buy the dip market of the last 10 years, why not get short vol every time the S&P drops, to short some out of the monies and capture that IV crush? Sure, that's been something that investors have been rewarded with over the last many years, so they continue doing it, and the amounts are getting larger. And I agree with that. That said, I don't believe particularly that that's the benefit that we have. Our skill set, and my background is a trader. So I started my career in the mid-'90s as a prop trader. I learned my trading skill. My first model I built was a trading model. I still run it today, and I still benefit from that trading know-how. For me, the ability to trade long vol was to really infuse the trading skill on top of volatility. You think of it as a thought experiment. If one is a trader, right, and what does it mean to be a trader? I'll just use a very simple terminology. It means that you're pretty good at buy low, sell high, right? That's the skill, right? And so you could trade anything. If you give a trader and you tell a trader, well, you can only trade tech stocks. So, well, if you told me that, what would I do? I'd bring up some charts. I'd look at Google and Netflix, and I'd start seeing their levels and their price volume behavior and characteristics. And from my experience, I'd figure out some good points to buy or sell and stop losses, et cetera. So a trader can trade. I took that same construct and just said, well, what if I constrained myself and I only could trade volatility? I could only trade long options. So I'm not allowed to trade any stocks or indices. I can only trade S&P puts, right? Where would I buy and where would I sell, and how would I do that? That was the original thinking, which said that if you have trading alpha, why not do that on long vol products or long vol instruments? And with that began the research. Soon over time, we realized that we could make more money, be long volatility more of the time by scalping, by trading to keep that position profitable. So I hope that makes sense or that answers your question.
It does, and it also speaks, I think, to the particular situation that we're in, right? Where, I would argue that the retreating liquidity conditions in the market, whether that's a function of passive penetration, i.e., a higher propensity for stocks to move with positive correlation on any form of extreme move, which creates positive convexity to the vol surface, has created both melt-ups and meltdowns. Right? And so people tend to focus way too much on the meltdown dynamic, but under those conditions, it exists in both directions, right? I mean, one of the unique things that we're seeing is a very significant rise in realized correlations on both up moves and down moves. But that type of environment actually goes very well with that, because what you're really doing is you're trading gamma, right? You're not really trading
that's what we're
volatility.
No, we're scalping gamma.
Right. And so how do you think about that in a world in which more and more strategies are effectively selling gamma, right? So the underlying dynamic of I want to sell weekly variance, right, or weekly puts, is that they have a negative expected return, and if I do it more and more and more times, probability leans in my favor.
Sure.
Right? That's kind of the traditional approach to it, certainly looking at the historical databases. But it doesn't seem to be borne out in today's markets. And we're seeing more and more dynamics in which realized volatility, we're certainly seeing this now, where the realized variance or realized volatility premium is failing to deliver. So does that affect the way that you think about pushing your positions, or as you think about analyzing the fact that there's more and more people on the other side of it? Does it change the way you think about the trading style, or are you primarily using the historical tools and then modifying it with your trading instincts?
I think I haven't thought about that so much, but what I could say instinctively is that all that could do really is improve our ability to trade. And so why would I say that? Sounds good. But besides for that is, at the end of the day, when the masses are getting short, they have to cover, right? And everybody's got their risk controls and their stop losses at some point. So when there's that squeeze, there's going to be that further push up. So as a trader, you like that, right? You like the melt ups and meltdowns. You like because there's bigger bands to trade. So if anything, to me, to your point, people are selling the shorter dated paper to get their portfolio looking Vega neutral, but at the same time, it's not, because one little move and it's all out of whack. They're synthetically creating this safety for themselves, which is not really there, right? And they're doing that to hedge probably some other larger portfolio that it's facing off to. I know that at the end of the day, all that positioning is going to have to be rejiggered to when something really bad happens. So that means I'll have more trading opportunities. That's in my mind. I haven't seen that play out. I've seen it a little bit, kind of bigger moves, but trading is kind of betting on a mean reversionary process, right? There's swings or undulations in markets, and in this case, in volatility. And so the bigger those swings are, the more gamma you can scalp during the swing. And so I'm going to like that.
Well, I'm also going to push back a little bit, because while you come from a very quantitative space,
sure,
your trading is largely discretionary in nature, right? You're not slavishly devoted to 3% decline, therefore I buy, or 3% up move, therefore I sell. Am I correct in that?
It's a mix,
okay.
Right? So you're right, it's discretionary, but my discretion is very systematic. I don't know that I don't know what it means to be fully discretionary. My discretionary approach has a rule, always has rules. So if we talk simply about a trade, getting into any trade, whether it's an option or an equity or an index, before I get in, I know where my stop, where my level is. I know where potentially a profit target or a trailing stop. I have that all in my head. So it's a rule-based discretion. Yes, sometimes you get into a position and it moves in a certain direction, and I had a feel for where it would go, but there's so much more volume in a move than you expected that now you're going to give it more space. So the discretion is, I'll say, a bending of rules is in itself just another rule, that if you get in and this takes place, then you have a new rule set. So what I've done in the vol trading approach over these many years, over the last 4 or 5 years, what we've done as a firm is build those rules, that discretion, into a systematic approach. At this point, therefore, it's not discretionary, right? What we're doing is we're trading it, we're following the system which originated from a trading instinct. And then when we see things in the market, I'm in the markets every day and I'm watching this thing trade and I'm thinking, what would I do here? Does our model, our system now align with the decision I would have made, given that we've programmed it into a structure? And when I see that it does, I'm like, okay, that's exactly what I would do. So my rule set is working the way I would trade it. When I see that it's not, or something different, then we go back to the R&D table, right? And we bring up the mathematics and we start looking at why is this not exactly what I feel like I would do? And we do some more testing, and that might be a tweak that's infused into a later iteration of the model. It's not a change that'll happen that day. I won't discretionarily say, oh, you know what, let's buy a few more puts today. I don't do that because we have a system. What I'll do is go back to the R&D desk and say, why did that not align with what I might have done personally? And then we have a new version that might come out 6 months later, if that thinking was correct or not.
So this is one of the things that appeals to me about this type of approach, right, is the marrying of human intuition and experience, right, the trading dynamic, with a formalized or systematic model. Right?
Yes,
and so,
I love that's a good summary.
So very few people that are developing quantitative models have the trading experience simply because they haven't been in the industry long enough to actually ask that question. What would I be doing if I was fully discretionary?
Right.
How does that disagree with what the model is putting out, right?
Right.
It tends to be, and this is one of the problems that I have with empirical finance, it tends to be very focused on what are the outcomes, right? So there are any number of times where rigorously repeating the same algorithm, doing the same thing, selling puts on a 10% drawdown will offer a positive payout, in particular because the data set that exists historically is genetic in terms of anthropomorphic in terms of its nature. It wouldn't exist, anthropocentric, I'm sorry, in terms of its nature, it wouldn't exist if the big one had come, right? And the markets had crashed, and we had the Russian Revolution,
works till it doesn't.
Right, it works until it doesn't, right? And so that ability to actually combine the two strikes me as different, certainly, than what I'm seeing from most of the quantitative approaches.
Yeah, and I very much agree with that. I see that a lot of quants come out of financial engineering school and they're right away into the programming, and they haven't traded a day in their life, but they've learned the models and they learned the programming. In fact, where Logica's offices are, we're very close to UCLA, and we have a deal with them, the MFE program, Masters in Financial Engineering. We get a couple of their grad students, or one at a time, over a few months and work with them. And it's very funny for me because they come in and they have all this knowledge. It's, of course, academic, and they know how to program, and they've learned the empiricism, and they believe that the models play out. And yeah, oftentimes they do, but sometimes they don't. And in fact, there's an occasion I had where I got into a intense is the word, debate with one of the students, and he was in my office, and he was saying that I asked him to do a research project, and he said, well, that's not going to work. That's not what the models say. And I said, well, I know it works because I trade it. So I'm asking you to go down. No, that's not what you can't, because I was looking for convex behavior in equities. And he said, well, equities aren't convex. No, some are, and there's certain, you can model that acceleration, right?
He must have missed the run in NVIDIA.
Yeah, right. Yeah, he missed quite a few runs.
Yeah,
and it was particularly in ETFs. But the point was that his understanding was that wasn't possible from the academic world, and we got into a big fight. So much so that he started talking aggressively to me, and I said, I just can't. I can't work with you, and leave my office. And so it was unpleasant, but it highlighted to me the danger of schooling. And of course, schooling is incredible. I'm very much believe in education, but there's nothing like experience and being a trader and doing it discretionarily for many years. So yes, marrying those two makes all the difference. And I trust empiricism. I'm a big scientific thinker, very analytical. I look at observed data, but I know in my heart that it's not stationary, right? It can't be, all right? Volatility is a good example. It tends to be mean reverting, but sometimes it pops right out. And so, I know this, and I categorize this behavior mathematically. I understood that, okay, we can rely on a mean reversionary process, but once in a while it's going to be mean expansionary. And so we have to come up with a flag or something that tells us when it's moving from one regime to another. We call this internally a phase shift, right? So that understanding that led me to build the logic around the phase shift was because of my experience as a trader versus if you read the textbooks, volatility is mean reverting, right? Well, not always. So yes, exactly that experience, or exactly as you said, is what I've dealt with over the years and why I love being a trader on top of doing the math.
Well, and it's really interesting though, because more and more people are locking themselves into non-discretionary formats, right? Whether that's an index fund that you contribute, biweekly as part of your 401k. I mean, that's the ultimate in terms of truly systematic.
Yeah.
It's basically as long as you are employed, you will be contributing to the S&P regardless of its forward expectations, right? Or target date funds, which are an area of real concern for me, where there's literally one input in terms of your investment process, your investment allocation. How old are you, right?
Right.
With very little thought given to the underlying components that you're buying because you're presuming that other people are doing that work, right? And so that sort of blind systematic investing seems to have really taken over, particularly in the younger generation. I think the older generation, which you and I represent, I'm a little bit older than you, very few of them have the tools that allow them to look at some of the systematic strategies or the quantitative approaches and say, here's the problems or here's the flaws.
Sure.
Right? And I would argue that extends to the phenomenon that value investing, for example, right? A long-standing phenomenon that is presumed to exist, for the really simple reason that people somehow want to buy glamour stocks, right? And therefore they're overpaying for those and underpaying for the other. Well, we're coming through the longest outperformance of glamour relative to value or momentum relative to value that we've ever seen, and you have to ask yourself, how did people feel so confident even just 10 years ago that value was this enduring phenomenon? I would argue that it's largely a function of people not really understanding what they were doing or not really understanding the tools that are in place and certainly never having traded.
To that point is value, or the growing up of value is probably reading the classic value books, right? Whether it was Buffett or before that, the Graham and Dodd, right? People read the literature and they felt, okay, this is what value is. And, and then that it gets overcrowded, right? And at the end of the day people are going with what I guess they've learned by reading or by discussing with others rather than being in it themselves. And that poses the risk. As far as we talked about our generation, to me, the big bifurcation is, were you around in 08? Were you trading? Like, I was trading vol in 08, and you know what? I was actually getting short vol in 08 because it was just so ridiculous. Once IVs passed 100, I'm like, okay, this is just insanity. I understand it can go higher. I understand. I know the risk, but at this point, I'm willing to take the risk, right? And so I was getting shorts and out of the monies, and I knew what I was doing, though, and I knew where I'd have my stop, and I knew how to roll it. But the point being is that if you've been through that experience, you're just a different person versus if you started in the market in 09. And so this generation, I guess all the quants that are now arising out of schools over the last 10 years have only been in the bull market, have been in the last 10 years post-08. And having not lived through that, having not lived through a major risk event, just puts you as you're in one cohort or another. And so having not just lived through it, but traded it, enables me. And everything I do, it's the big what if is always in my body. Right, I have decisions I make, and I say, "What if?" And in fact, we have in a lot of our testing, we have the with and without await, right? Because if you do a lot of simulation or walk forward testing, and we know how to test rigorously, right? So we understand the issues of mining and fitting and all that, and we're very careful with how we set up our experiments and our studies. But when we do, we always say, well, okay, this is how it would perform, and now let's imagine '08 didn't exist, and this is what it did. And it's really amazing to see the difference. And so the question becomes is, do you imagine that there's going to be another '08? Well, probably not, but there very well may be, or maybe it'll be a 25% off rather than a 50% off. So that part of it is the discretion to say, I know what can exist, I went through it, I know how to handle it, but it probably might not be the case. And so all those decisions is what we're going through. And just having a data set that is with and without is what we do when we've been through it. When you haven't been through it, your data set is in fact, most people are testing the last 10 years. And so they'll just never, '08 will never be in their data set. And it's always going to be a different outcome.
Well, it's not only going to not be in their data set, right? I mean, many articulate that an '08 can't happen because they view, I would argue largely because they view it as an economic event, right? So it's, the way I look at '08 is, and it's fairly clear in the data that there were two separate components, right? So there was the recession, which was relatively mild, although in a deep sector of the economy in the form of housing, that was radically exacerbated and accelerated by what I would argue are largely political errors around the failure of Lehman and then ultimately AIG, right? Where I think what people fail to understand is that if you had cash with Lehman Brothers International, which a sizable fraction of the hedge fund community had, or if you had insurance from AIG, which a sizable fraction of the population had in terms of the investment community, suddenly there was volatility to your cash, right? And so if volatility attaches to whether or not you actually have cash, then what does volatility have to be on every other asset is effectively where it reprices, right?
Yeah.
And so, and you can see this fairly clearly in the data where it just becomes nobody has cash, right? Nobody knows how much cash they have. Nobody knows who's on the other side. That's what counterparty risk is. They don't know if they have cash that they had yesterday, right? And so, that feels like a very different data set. But if you think about it in those terms, as a counterparty or as a financial failure, it feels to me that the probability of that actually has begun to rise, right? As we've seen the opposite of what we thought was going to happen occur from 2008, which was a re-regulation of the financial system, that nobody was going to be too big to fail, that we were going to fix all these problems. Now everybody's bigger and certainly more condensed.
Yeah. I see. I have two kind of positions on that.
Yeah, please.
My first position is, to me, '08, at the end of the day, was a short vol trade gone wrong, right?
Yep.
So just as you were talking about earlier, the increasing amount of short volatility in the markets today is, in '08, was just that. The short vol was, credit default swaps were short vol. They were, out of the money, derivative risk, that the counterparty, could they cover that volatility that they were selling? And they obviously couldn't. AIG could not, right? And the whole mortgage market, where all these bonds or securitizations were pricing mortgages on the assumption of a normal distribution. And of course, they were fatter tails. And so the mortgages out here, the subprimes, weren't priced into the default risk, right? And that was not correctly pricing the left tail. It's the same thing, right? So whether the left tail is generated from bad underwriting on mortgages or from today overly short in all these ETN or ETP instruments, it's the same thing. It's short vol is the kind of destruction, right? So to me, that there is a resemblance. To your point, though, it's not this massive economic systemic issue, and so we don't know whether it might not be as big. So I see similarities, and at the end of the day, the underlying math is the same. The statistical inference problem is the same. The extent of it might not be as broad. I don't know. That's kind of my first position. My second position is largely, I've learned over many years of being in this business, is that I just don't know, and I literally don't care, and I mean that in a very positive way. I don't believe anybody has any idea what's going to be in the next 6 months. The funniest thing was Q4 of 18, right? December, the market's tumbling and just straight down, and everyone, now this is it. The world's ending, and then by January 19th or whatever, somewhere around there, it's recovered all of it. I mean, and everyone forgets, and then we're off to new highs. And like, should we ever be scared again? Who knows? But the point is that the panic during December was superseded by this just euphoria in February, right? Because January then had brought us all back. So I don't think that if you asked all economists or market commentators in mid-December, where do you think we're going? Well, this is it. I don't know. Everyone's scared. and then suddenly everybody's not. And nobody has any predictive abilities. There's just so much. It's all so much larger than ourselves. There's so many variables. It's all confounding. We can't extract or isolate what the influencing variables are. Therefore, my position is, don't worry about what's going to happen. Just be long vol. Because whatever happens, that's going up. I don't care how, why, or what the cause is or the root, or it's all irrelevant. It's like, why worry about the whys when it all collapses to the same result? Vol goes up. So if you could be long vol, then you don't have to care about why or when. You just stay long vol, and when it happens, you win. I think it's as simple as that. I don't know if I'm being too simplistic, but
No, you're not
that's how
being
I
too
see the world.
simplistic, because
Yeah.
ultimately, I mean, what you're describing though is a dynamic. And again, I would assert that the structure of volatility has changed because of the preponderance of people that are now selling it. And this is,
Sure.
most people will assign it to the idea that central banks are, suppressing volatility everywhere. And there's some truth to
Sure.
that. Certainly policy, particularly in the behavior of cutting interest rates in response to declines in asset prices, which by definition raises the price of bonds.
Sure.
Right. And so restores balance sheets on the financial system side, right? So that is a vol dampening exercise.
Yes.
But I think the response to that has been this flood of capital that now goes into the direct selling of volatility, whether it's weekly or monthly variance swaps, or it is products like the XIV that spectacularly blew up in February 2018,
Yeah.
or it is credit, right, in the form of CDS, which we see very aggressive selling of credit, or it's vol on commodities. And so what people are trying to do is they're trying to engage in yield enhancement strategies.
Yes.
To offset those very low yields that are being generated now from risk-free instruments, right? That is kind of the central tendency. But that provision of capital, that willingness to actually sell vol, to sell insurance, perversely creates these dynamics until you run out of incremental capital and somebody starts to ask for it back.
You're buying yield from the devil.
Right, exactly.
Right.
Exactly.
Right. It's risk transfer.
Right.
Yeah. And there's a great paper called Conditional Skewness in Asset Pricing.
Sounds like a great paper.
It is. It's a great, yeah. It's Harvey and Siddique from
Yep.
Duke and Georgetown, I believe.
Okay.
Wrote it some time ago, and I just love the paper. It's one of my favorite papers. They describe all negative skew is risk transfer, right? So this nice hit rate that we have, and we live with a hit rate, and we receive this positive carry for a while. At the end of the day, the piper has to be paid, right? Because that hit rate is higher than it should be because there's the left tail. So you're taking the pleasure now, and you'll receive the pain in some time from now. And I love that way of thinking. Is everything you've described is that, right? Everyone needs the yield now, not realizing that we're going to have to pay for it in the end. And if you look at your expectancy over the long run, it's much lower than you've experienced for the years that you're receiving the positive carry. It's all just awaiting the risk transfer.
Well, it's one of the things I think is so interesting, because you've dug into it from a mathematical and a empirical standpoint to identify these phenomenon.
Yeah.
I think about it from a purely theoretical standpoint, right? And I think at the crux of what's here is part of what you're just describing, which is that we have a retiring population, an aging population, a sizable fraction of it, that needs current income from their financial assets. They don't have another lifetime ahead of them to save even more financial assets, so they need to figure out some way to generate yield from those assets, even as central banks and regulatory authorities are in the process of trying to crush that yield, right? With the idea that creates economic stimulus. Mm-hmm. But in order to do that, they are transforming their portfolios from ones that should be investing in fixed income, where there's risk of, there is obviously more risk to this, but in simple terms, fixed income securities look like a football in terms of their payout structure, right? They start with whatever you paid, and then if you have a low interest rate environment, the prices move high and then flatten out over time. And if you have a high interest rate environment, they initially mark down against you and then they close on par, right? But at the end of the day, you know what you're getting in a high quality fixed income instrument. You're getting par. People are engaged in taking strategies like call overwriting or variance selling, where your endpoint is entirely uncertain. Right? It's a cone of possibilities that rises over time. Sure. And you're using that to generate your current yield. It's a fundamentally very, very different product with a very different payout cycle and pattern of cash flows. And I think the risk is that we wake up and realize that those uncertain cash flows at the terminal point are going to be the nightmare scenario for us.
Yeah, I agree with that. And in fact, to me, it's the uncertainty is, I mean, that's the risk. It's right, and so you talked about a cone. It goes out. The unknown is. How am I thinking about this? It's so much more risk than people are accepting, and I mean, we're both saying the same thing. We're so different in a way that you think a lot about the economy and the macro and what's going on institutionally and the baby boomers and the results. And so it's large scale looking down. And myself, I ignore all of that. I'm in the weeds. I'm in the math. I'm in the trading. And I don't think it matters what's going on in the bigger world because I can see the outcome of the behavior in what I'm doing. And I don't want to model for what variable I think is going to influence it. I want to just know, no matter what happens, this is what my results will be, and this is why. If I buy a put option, I know that no matter why the market goes down, it's going up, right? So I want to know how best to buy a put option. And so going back to what you said is this such an interesting difference between us is that we're thinking me from the micro, you from the macro, but we converge at the same place. We both see the same problem. We both see in the market the issue, and we're both working on solutions for it, but from two different worlds.
Well, it's interesting because you have a long history of writing what I would consider actually extraordinarily eloquent for somebody who has a mathematics focus. And you and I actually first met over Twitter, where it was kind of, we had this mutual dynamics like, okay, this guy knows what he's talking about, right?
Right.
What I would argue that both of us are kind of picking up is grounded in that dynamic that we both trade, right? And so there's many people that I see here, make statements something like, well, the market feels off, feels like it doesn't react to information in the way that I remember, but they don't have the skill set or the tools to dig in on the math and actually say, here's what's driving the difference, right? Because you're so deep into it, it's almost like the waves are speaking to you, like you're on the waves.
Yeah.
Right, and I'm looking down at it and basically saying, okay, there's a difference in the structure of the market. Let's try to figure out what's actually causing it.
Right, and I'm like, I see it.
Yeah, no, right. and you have, so it's like, hey, there's a big wave there.
Right.
And you're like,
whoa, duck.
Yeah, exactly.
Right.
Yeah. So I agree with you on that. I think it's fascinating, and I think it is one of the interesting challenges is how are we going to, with these challenges and changes, is there something that we can do other than just make money from it? Right, and I think your focus is absolutely, let's do this. And the benefit for me is having somebody as smart as you that I can turn to and say, hey, are you seeing the exact same thing?
Yeah.
I may be a little bit more concerned that this is not sustainable, and that the implications are going to be quite significant and systemic in their nature.
Sure. And so to the question that you posed right before you finished there, is there anything we can do with it besides make money? I have a big absolute yes. And that answer is protect others, right? Yep. So it's the beauty of right now. So I have this volatility trading or tail risk product, and the beauty of it is, one, making money, but the money we make or the money it makes is directly proportionate to, if somebody's hedging their portfolio, the money they're losing somewhere else. And so I'm protecting them. And it's a very interesting side of the business. I actually like it a lot more than many other things I've done in trading. And most trading or models or strategies I've built over the years have been primarily make money, like build an alpha source so that we can have higher returns. In this case, it's, that's nice, and that will happen naturally given the product itself. But at the same time, you're making everybody who's chosen to invest with you so much happier when that event comes, and the rest of their beta is down, or the beta in their portfolio is down, whatever, 20%, and because of this tail product that they put next to it, it's up 18. And so net, they're fine. And the smile on their face, I know the experience for myself is when certain down, just like Friday was a day in the market, the S&P was down 2.9, and our portfolio was up nicely, the tail product was, to the point where it covered the rest of the strategies that we have. It was a net positive day on a multi-strat of products. Not products, but on multiple strategies, I'll say. So to me, the comfort that sits with me to say, okay, you can do all this other stuff in the market, and think of any ideas you want, whether you're a value investor or you're a growth investor, you're fundamental, you're market neutral, you're stat arb, you're merger arb. Go down the list. if you have this next to you, then whenever this has trouble, you'll feel better at night. And therefore you can sleep. And therefore you could focus more on what it is that you do well and get better at merger arb because you have this tail risk product next to you protecting the stuff that you can't think about. And that's what I like more about tail risk protection than any other strategy I've been involved with, is that you're providing a real service to the market. And it might sound cheesy from a Wall Street perspective, but to me it feels good. And I see that with people I discuss it with and I talk to, and current investors I'm working with to take it on. You give them a good feeling along with a return profile.
Well, it's interesting because I share your sentiment. I mean, the way that I look at investing and my current configurations, which are like yours, long volatility, is it's the only way that I can actually sleep at night knowing that I'm engaged in a fiduciary activity, right? That I'm basically saying, I think all of this is craziness. I understand people's view that, the role of a hedge fund manager or of a macro investor is to buy the bubble. I'm concerned enough about the sustainability of it that and the idiosyncratic dynamics in terms of market structure that are being exposed, particularly changes in the correlation features, that this is the only way I can sleep at night. It's basically saying my portfolio is largely constructed of lots of long volatility, short delta bets where I hedge the top side, basically, right? I try to make sure that I'm not getting anyone killed in the process.
Yeah.
And I agree with you that it's important to be able to share that and have that dynamic. But it receives such a bad name, right? Coming out of the last crisis, right? So black swans, the black swan terminology, which is a terrible terminology in a lot of respects now because it's so overutilized, but that became such a cottage industry, not even cottage, mansion industry, post 2009. Do you find people are resistant to the idea of expressing long volatility in this regime?
Yes, I do, but not necessarily because of the terminology or the association. The black swan sort of has become part of the kind of market nomenclature, and so that's, people talk about it all the time, but what people, I think, hesitate about is the bleed. It's as simple as that, as insurance costs, right? And I think about getting health insurance or car insurance, and you call up the different insurance companies, and the less deductible you want, the more expensive it is. That's at the end of the day, what's good costs, right? And people realize that, and they realize how much they need insurance. People don't get in their car without car insurance. They don't walk out of their house without health insurance, but they don't want to pay it when it comes to their portfolio. And I see that a lot. So for me, that's why the dedication, the focus has been, how can we do this? How can we stay long vol all the time, but in a way that can make money? And the amazing thing is, because there's so much bleed in the market associated with having insurance, you don't need to do really well when the market's up. You just need to make a little bit so that people can have that in their portfolio and answer to their board of directors or answer to their the senior PMs about why they have this piece that's lagging. I mean, I completely don't understand. It actually frustrates me tremendously when people, why not just buy puts and naively roll every month just a little bit of your portfolio, spend 1% a year on puts. People don't, because, I don't want to lose 1%, but you lose it until it pays off everything, that it becomes your biggest winner. I don't understand that mentality, but I do understand it when, because I've had conversations with the institutions about this, is that they're competing with every other institution in those investor statements that go out every month. The investors are like, well, I'm getting 100 bips a month over here, and yours is only 90 bips a month. What gives? I'm going to move over to this firm. So they can't even give up that 10 bips to protect the book. That's the right, as a fiduciary, it's the right thing to their clients, but they won't give it up because they're competing with the rest of the market who's not doing that. So they cannot afford to have an ounce of bleed. Therefore, to me, the ultimate solution, which is, again, what I've been working on, is the ability to make a little bit of money so that it's not a bleed in the portfolio, but still maintains that amazing long vol and convex profile.
Yeah, I think that's a brilliant insight. The idea that we're constrained in terms of what we can offer and how we can behave as a fiduciary by the behavior of everybody else.
Right.
I had a conversation earlier today where I was discussing the underlying dynamics of multiplayer games, right? And it's very easy for you and I to have a discussion and say, we should have some insurance in our portfolio. Okay, what are we going to negotiate? What's the 1% down, et cetera? Right. But if there's another person out there who's saying, well, I can do the same thing and I can offer similar characteristics, but my insurance costs less, right? And because we haven't had the drawdowns, because we haven't had the negative experiences, his performance or product looks superior, at least optically, because I haven't seen the negative skew dynamics. I haven't seen the negative convexity in his portfolio, right? I'm competing with that guy.
Right.
And so his claims sound not only valid, but more profitable than somebody who's engaged in spending that little bit. And so it does become a challenge of how do you capture and how do you retain those clients. If you were to think about where some of these dynamics begin to switch, right? I've had a number of conversations with individuals about some of the underlying volatility supply in the market, whether it's Uridashi bonds or auto-callables or variance selling by pension plans, et cetera, the retail participation in the VIX complex, the VIX ETN and ETF complex that we saw in 2018. Do you see a point at which those dynamics could switch when you look at kind of the surface of returns and you look at the surface of the market? Is there a flashpoint where things change?
I feel like it's investor sentiment driven by what just happened, right? What's the last thing I experienced? I saw this directly and concretely in December of 18. Is I had a few institutions that I was in conversation with, and I hadn't talked to one of them for a few months, and suddenly on December 18th, how'd you do today? December 19th, how'd you do today? And December 20th, how'd you do today? And I had this daily email of my numbers, and that's the first time you've wanted to see my each daily P&L, and not necessarily. They have asked for it before, but it was like that in real time via email versus I've sent them spreadsheets before, and so that's it. When things start happening, when the panic sets in, and it's even mild. December wasn't that bad. It was at the bottom maybe 11% down on the S&P. It's a correction. I guess a correction starts at 10%, perhaps, if you want.
Well, it was 11% down for the year, but it was 19 and change.
Actually, it was right. So it was more extreme. Sorry, I forgot the detail. So that then gets extreme. But my point stands that when that's happening, that's when people start needing it and wanting it. And I think we saw the same thing in 08, right? After 08, that's when a lot of the tail funds exploded in assets, right? It's just happened, and now we want to, everybody wants to protect. Well, it's probably the wrong thing to do at the bottom, but actually it's never the wrong thing. So I don't know about that. But the wave of the bull market has to turn a little bit, and I think I don't know if we're seeing it, but I've seen some characteristic change in the markets just over the last few weeks, right? There's vol is higher. There's definitely a pickup or a change in character, and that might be the beginning of something, maybe not. Who knows? When it starts to unfold, that's when it gets attention. And the nice thing is, if it's not what we were talking about before, is how the next crisis or crash or correction never looks like the prior, right? It won't look like 08. It never does, right? So if you go back over prior corrections of the history of markets, or as far back as we can look at, 1973, 74, driven by the oil embargo, and 1987, all of these events looked very different, and we won't have an 08 again. It'll be different, but what they have in common is outside of December of 18 is they tend to last a while. And, generally bull markets last longer, but these bear markets or these correction phases can last a year or two, so if not longer. The point being that once it starts, if people get protected or if there's a new rush of the crowd to get protected, then they'll be better off over the ensuing years that environment lasts. And so it'll not necessarily be too late. It'd be nice if they got started now, but there's always going to be tough market environments, and we have to wait till it begins for people to wake up to say that, yes, this is possible. That's my feel, yeah.
Well, I definitely agree with that, and I would highlight that when people realize that they want that protection, they begin that rush for the exits, or for the protection. That's typically the signal that they are too late to the party, but hopefully the outcomes aren't as adverse as they have been in prior cycles. Yeah. Wayne, this was absolutely fantastic. I really am glad we had the chance to sit down in front of people. Yeah. If people want to follow you on Twitter, what is your handle?
It's my first and last name.
Wayne Himelsein.
Wayne Himelsein, yeah.
Okay,
yeah.
So at Wayne Himelsein.
Wayne Himelsein, yes.
And do you write on Logica? You have some research papers you release every once in a while?
Yeah, we've done a white paper actually on skewness. We had it was called the skill metric, or it is called the skill metric. We reshaped the Sharpe ratio to account for negative skewness. It's a big problem with the Sharpe ratio that it, number one, it penalizes for upside vol. Number two, it discounts negative skew, which most assets have, most certainly most hedge funds or most alternative assets. So we used some neat mathematics to create a skew-adjusted Sharpe ratio, I'll call it. That's a paper we did some years ago and certainly downloadable on our website. The other thing is I do I won't say monthly, but every month or two, a blog post. I started that maybe 8 or 9 months ago. So it's a little posting I do about whatever topic I'm thinking about. And we've gotten some good feedback about that. And I like the writing of it. So whenever I can find time and I have thoughts on my mind, I like sharing it. And so, yeah, we'll continue to put out those.
Okay, well, I would encourage people to check
Yeah.
those out. I'm a huge fan of your writings.
Thank you.
And I would really love to have you back on in 6 months to a year, and we can check and see how things have evolved. My hunch is that we're going to see a lot more demand for higher vol exposures or vol protection over the next 12 months. And I can't think of anyone I'd rather have back to talk about it when it happens.
Thank you.
All right. Thanks
All
a
right,
lot.
Thank
Wayne.
you. Okay.